Ladies and gentlemen, what is going on? It is your man Z Moose coming at you live from the Moose Den. Tonight we are going through part 2 of TMO Trading Steps. Part 1 of the series was last night, and at the end of the series on Saturday evening, I'll be putting them all together in one nice, cute little package for everybody to look and review. It's also going to be in one blog post, so if you ever want to reference it, you don't have to reference 4 blog posts. Bingo, it's at your fingertips. Tonight, we're going to be talking about defining your parameters and measuring your risk and reward. This is easily one of the most important steps when kind of trying to pick a stock. After picking your target and finding out your target and really knowing your target, this is the number one thing to do to have a successful trade and to have a higher chance and a higher probability of making a winning trade. So the first thing we're going to be discussing tonight is defining your parameters. Trading parameters are prices at which you are willing to trade between, whether it be support and resistance, trend lines, price patterns, whatever. It is 2 levels that you can look at that if the company and the stock that you are looking to trade is in between those 2 things, you will be willing to take a trade at some point in time in those 2 areas, that parameter. I use Thinkorswim's charting software to define the parameters of trades I take, and I do it technically. Other popular charting softwares include freestockcharts.com, stockcharts.com, and interactive brokers. I know that a lot of people use freestockcharts.com and stockcharts.com. It's very easy for them, and the subscription is nice, and they don't have to go through the hassle of using Thinkorswims and learning an entire charting software and everything that goes along with it. StockCharts and freestockcharts.com, both of those are very, very basic. Interactive brokers and Thinkorswim, they're a little bit more difficult and a little bit more complex to comprehend. But the first thing that we're going to be doing tonight is going to be looking at defined parameters, and what better stock to choose than to look at Apple making new highs today at one point at 272.90. So I drew it up here, and we have, the one thing that we can look at is we have this ascending trend line here. Not really relevant right now, but we had this higher low. I was looking for the double bottom at 230. We had the higher low instead, where we had this first bottom at 230 and the higher low at 240. The stock continued to run. Our first resistance level was 266. It broke above it, drove to 272, and it broke above that very, very, very quickly today, but pulled back down to close below it. So the parameters in this particular trade that we would be defining would be 266 and 272. Those would be the 2 parameters that we would be looking at, and those would be the 2 parameters that we would technically define, that if I were to take a trade in Apple, these would be the 2 levels that I would be looking for the price to get into the company. So let's say tomorrow there's a huge tech problem, iPhone 3G is having issues, whatever, I don't care what it is, make up a reason as to why the stock of Apple drops, but holds 266. Let's say it's trading at 267, and you want to get in. You think this is a good time to get in. Now we move to step 4 of the trading steps. Step 4 is measuring your risk reward. Measuring your risk and reward in the minds of some traders is measuring how much you can gain from a trade. The way I learned it, and I learned this over the course of about 1.5 years of trading, one of the most important rules and things you can remember and take away from trading is that the proper way to think through a trade is to realize how much you can lose and plan accordingly to that. So instead of measuring the reward aspect, you want to take more time and more dedication to actually measuring the risk. Instead of saying, oh, I can make $3 grand, $4 grand off this trade, and you don't measure your risk, that risk on that trade, you may be wanting to gain $4 grand, and you may have the potential to gain $4 grand, but your risk might be that if it goes sideways, you could lose $8 grand. And I don't know about you, but if a trade went sideways, I would not be wanting to be on the losing end of that particular risk-reward setup. So, when we're looking at this risk-reward, we need to make sure that our reward is greater than our risk, and we minimize our risk, and we mitigate our losses, and we make sure that we cut our losses appropriately. So, measuring stock trading and options trading risk reward are two very different things, and I just wanted to just sort of jab that into the mind of you guys. But the main thing that I'm trying to convey here is that option trading is much more complex than stock trading, and when you're looking at the risk reward setups, it's even more complex. I'm not going to get into options trading risk reward tonight because I'm learning it myself, and I'm still a very, very novice trader when it comes to options trading. Stock trading, I am very free to talk about risk reward, and that's what we're going to be doing tonight. So, without further ado, I use the Analyze tab of my Thinkorswim platform in order to help me measure my potential risk reward. So, if you do have Thinkorswim, this is a great way to kind of analyze different kinds of trades when stock trading. If you don't, I will explain it manually as we go along. So let's first check out Apple, and we were discussing our parameters in between 266 and 272.50. That is our parameter of trading. It is defined, and if we're willing to take a trade at 267, then it's Friday. It's like mid-afternoon Friday. Apple's at 267. It looks like it's going to start popping again, so we decide to take the trade. But beforehand, if we were saying, okay, I'm going to get into Apple at 267, 266 is the support. I don't want to take the chance and see how low we can go and see if we go and test the support. Let's take it now, and I can have a $2 stop on my original position. So, without further ado, let's buy Apple. Let's buy a share of Apple, just one, that's it. And let's check out our risk reward. So one share of Apple is going to cost us here $267. And from this window, we go to the risk profile. Risk profile is very, very neat. We're already set up here. This is our entry point at $267. If we are willing to put a $2 stop, if 266 is our support, and we're willing to put a $2 stop from our original buy, which is 267, we will stick our stop at 265. So as you can see, we're really, really minimizing our losses here because we're making sure that our risk is less than our reward. So if this were to fail, and if this support level were to break down from our original buy point, we would be okay, and we would be fine. To do this by hand, all you have to do is just measure your percentage allotment and make sure that the amount that you are losing and the percentage that you are losing on this trade, this particular trade, in this case it would be $2, because we're only buying one share. If we bought 10 shares, we'd be losing $20. 100 shares, $200. 1,000 shares, $2,000. So as you can see, as we keep going up by intervals of 10, you just keep adding zeros. So no matter how big your account size is, you can use this to determine what your risk reward is. Here, our maximum reward, if we are looking for a breakout and a continuation, let's say $2 above the current resistance that we're at. So if we bought at 267 and we're thinking that this is going to pop and keep going, this is a fake out, a shake out, whatever you'd like to call it. Let's set it at 274.50. That's where we're going to kick it. So we have now, on 1,000 shares of Apple, we have a $7,500 profit against a $2,000 loss, bringing your risk reward to 3.75 to 1.